Everybody, I'm Toby Gennaro, and we've got a good-looking crowd on this morning, so let's do a sound check real quick. Make sure that you guys can hear everything all right. You can see the current splash screen. It says part 2, a precise trading strategy is going to be our topic for today on the second week of the series. So if that's all good and coming across loud and clear, if you guys can just let me know via the question box on your screen, that'd be great. And then we'll jump into the content here without further ado and get through some of what we're talking about today. Great, looks like everything's good. So let me get the recording started, and we'll do a formal introduction for recording purposes and then get straight to the content. Hello, everybody, and welcome. I'm Toby Gennaro, and I'll be your presenter for today. The topic for today is a precise trading strategy. So I'm going to be talking through the basic setup of 2 trading strategies that we use ourselves every day in our own trading room. And as part 2 of a 3-part series, I'll be introducing the key concepts of the strategies today and how to implement them properly in your trading. So for those of you that are on the live webinar this morning, if you have any questions during the session, please do just type those into the question box on your screen. I may be asking you some questions as well, so we'll try to keep this interactive, which always tends to make things a little bit more interesting. All right, and let me put up the risk warning and disclaimer as we normally do. Got to do this as part of the business. I'll leave this up for about 30 seconds or so. If you guys could just have a quick read through, that would be good. What this is saying in brief is that we provide education only, which means we do not give any financial advice. And as most of you know, trading the markets can be risky. It's not suitable for everyone, and you should seek independent professional advice. Okay, everybody good there? And just one more disclaimer here from Nadex, a short one. If you can have a quick read through this one, and then we'll jump straight to the content. Okay, then let's moving right along. So as we continue to build upon the principles that we learned last week in part 1, which included a detailed overview of the ingredients of the 2 strategies, if you recall, today we'll be discussing then how to use those ingredients in the actual trading strategy setups. So as we talked about last week, strategies are going to be the recipes that we'll be using to take our knowledge of the ingredients and then combine them effectively with a precise set of rules. So we'll look through a number of practical chart examples today to show you how to enforce those rules in an actual trading scenario. So just keep in mind that it will take some time for you guys to become familiar with these strategies, to actually get good at executing them flawlessly in real time. So you may need to see these webinars again in the future, and you may have a whole different set of questions at that time about some of the same information. It's like anything else in life. Repetition is good. And it's really going to be, the key to success in learning something new for yourself. So just allow me to introduce the agenda for today. For part 2 of the 3-part series, we'll spend some time on the how and the what of chart patterns and the types of patterns that you want to pay specific attention to, such as common continuation patterns and reversal patterns. So I'll show you how to add multiple time frame analysis to these ingredients that we studied last week. Helps to improve the trade setup probability. And most importantly, we'll take a look at reward to risk trading and what professionals do consistently on each and every trade. That'll be a really important one. And then for the moment that I think you guys have all been waiting for, go ahead and walk you through the 2 trend following trade strategies just to help you effectively trade with the market flow. Okay, the momentum breakout strategy is going to help with looking for those flat levels and those breaks that occur often in every strong trend, and precisely how to enter those trend formations. And then we'll take a look at the trend flow strategy, which will help us to look for precise pullbacks right into that buy or sell zone with a very strong trend, and then identify the pullback structure in order to safely join the trend at that point. And then we'll look at plenty of practical examples to see these strategies in action, so you can kind of get the hang of what we're talking about here. This is an example of a momentum trade going long. Okay, so by the end of the day, or by the end of the session today, you'll be able to read this chart and determine the multiple technical factors present for going long this market. So you can see the flat level forming right here. okay, at resistance, and then we'll be looking for a breakout of this level to go higher, and I'll show you all the key things to look for in the next hour of how that trade works out. Another example here of a flat level breakout to the short side. You can see that right here. Nice, very precise level consolidation, small candles right there. So as you begin to see these chart formations more often, you'll become better adept at scanning through a series of charts and time frames to better identify these types of setups. And as you can see, we have that flat level setting up. The moving averages have now rolled over. They're all getting into alignment, the 50, the 20, and the 10. And I'll show you today how you can position yourself on this type of a trade to move into a short to take advantage of the setup. So by the end of the session today, you should be able to answer this question: how many reasons are there for going short this particular market looking at this particular chart? And we'll do that for both the momentum as well as the trend flow trade. And here we're looking for a pullback structure with that trend flow trade strategy, the second of our two trading strategies. Here's just a classic long setup with price pulling back into the buy zone. As you can see right here, creating that high probability chart structure that we want to see. And then we find our bullish setup candle in the buy zone on both charts, and we're ready to lock it up and jump on the trade. Here, a nice short setting up again with the trend flow strategy. It's right up against a prior level of support, which will now become resistance for the next move lower. And again, by the end of this webinar today, you'll be able to spot this setup for yourself and be able to run through the checklist and decide on your entry point, your stop, and your profit targets, all based on the underlying price action, not based on any type of guesswork or anything like that. Okay, fair enough? All right, so as before, this is our promise to you folks on the seminar webinar today, to support and educate you on our easy to understand universal trading strategies that are applicable on any time frame in any market. So let's get started then just by learning a bit more about some common chart patterns and how to identify those to kind of get your eyes trained on really the structures that we're looking for. We're not looking for individual candles. We're not looking for indicators. We're looking to trade off of a complete chart structure that agrees with our strategy. All right, so getting underway here. Traditional trading education is usually focused on chart patterns as the basis of a strategy. So what I'm saying here is, instead of focusing on learning all of the various patterns and the corresponding names of those patterns, what we want to do is we want to pay special attention to what's happening behind the price action, or in other words, the psychology behind the chart pattern that we're seeing take shape in front of us. So just by understanding what's really going on in the underlying price action, I think you'll be better served to, as you look to position yourself going in the direction of the major flow of money in and out of the markets that you're trading. So we're going to focus on two basic types of chart patterns. We're going to look at reversals and continuation patterns. Today we will use reversal patterns to identify trends that are showing signs of weakening or potentially reversing. Many types of these patterns exist, but we'll use some specific patterns to help us understand when we should consider trading in the direction of a new beginning trend. And then we'll be using continuation patterns to help us identify strong trends and then look for key levels to jump on board that trend. Continuation patterns are typically bull or bear flags and consolidation type patterns. Now, once again, if you guys have any questions as I go through the slides, feel free to shoot over a question on the question box on your side, and on my side, I'll be checking that box as well pretty much after every slide. And if there's a question I can respond to while it's still fresh in your mind, more than happy to do that. Okay, fair enough? All right, so let's walk through the two reversal patterns on this slide and the next one. The first pattern here being the double bottom, double topping pattern. So when looking at a double bottom pattern, like the one that you see, right here, What we're really doing is we're looking at the lower highs and the lower lows of the downtrend. And then we're identifying the first higher low in this scenario. Okay, so once we have a higher low established, then we can anticipate a higher high to follow, such as right here, which provides us then confirmation of the actual change in trend which occurred back here. Okay, so double bottoming structure is no more than really just a change in trend. So what you're doing is really understanding the underlying price action at a more detailed level, other than just looking for a simple retest of of a particular level. Now let's go ahead and take a look at the opposite, which would be the double topping pattern. This is going to be the exact opposite of that last example. We have an uptrending chart right here with higher highs and higher lows, and once again we are just looking for the first lower high in this uptrend. Okay, and once the lower high is in place, now we can anticipate the first lower low. Okay, and again, the double top structure is simply a change from uptrend to downtrend. We're not necessarily concerned with the pattern names. We're just looking for those changes in trend and in the price action, which are going to help us navigate a trending market. Okay, now we're not looking to trade reversal patterns like this. We're looking to trade strong trends, and if we're trading this uptrend and we start to see this kind of a formation, then that gives us a lot of information to say, hey, you know what? This trend looks like it's breaking down, and I don't want to be trading this trend long anymore. I just want to move to the sidelines and let the price action give me the next signal or the next trade setup. Okay, so that's how I would be looking at that, and then really the same thing here for the downtrend. Here's the second pattern that I mentioned, which is also fairly well known, the head and shoulders reversal pattern. Again, this idea here with reversal patterns, again, is to focus on mastering trends. And in that way, you will essentially have already mastered market reversals without actually getting bogged down in knowing all the different names of the chart formations. So let's go ahead and explore the head and shoulders pattern in a little detail here. Here we have a downtrending chart. Okay, we have lower highs, lower lows, and then different from the double bottom pattern where we went from a lower low to a higher low. In this case right here, we go directly from a lower low to a higher high. Okay, which signals us to the first development of that left shoulder and that head development, and then we put in the higher low at this point, which then puts in that gets the right shoulder confirmed, and then the head and shoulders pattern is completely in place with the head, and then the left shoulder and the right shoulder. So left shoulder defined by the previous lower low, and then the right shoulder defined by the higher low. Okay, and then basically you have the neckline right here, and that's always going to be defined as such. So key concept here is to watch the trend and identify these first signals, and that's going to give you advance notice of a potential change in the current trend. Continuation patterns. Okay, these are going to be price action signals that alert us to the potential that price is likely to continue in the current direction. Here are some of the names of the more popular continuation patterns: ascending and descending triangles, bull flags and bear flags, consolidations, symmetrical triangles. Those are some of the other names. But once again, the focus here just needs to be on why price is continuing in the current direction. Okay, what's the main reason for that? And we can summarize all of the above descriptions in really one simple word. It's called breakout. Okay, it's just price action breaking out of an established pattern to either move higher in the direction of the predominant trend or to move lower in the direction of the predominant trend. So trading the breakout, that's what the momentum breakout strategy is all about, the one that you're learning here. So to better understand the nature of breakouts, This is the explosive force with which price breaks through a resistance or a support level. Okay, so this is sort of akin to the power of like a volcano. Builds up to a point where the pressure can no longer be contained and the volcano erupts and you get this immediate surge of energy. Now, scientists can, they can tell when volcanoes are about to erupt. They can take some preventative measures to preserve human life and so forth. And, it's very much the same way with a breakout in terms of a trade strategy. We can also tell when price begins to build up that pressure, and we can also anticipate that breakout at a very specific point in the price action. Okay, we don't know exactly when, the timing of it, but we do know at what price. And so based upon the time frame that we're trading, we do kind of have a general idea of the timing until breakout, which just really makes this a great trade to have in your bag. So we did spend some time last week in part one, just talking through flat levels, how to identify them. This is where we're actually going to use them. Okay, so our job as traders is to identify a well-defined flat level and then trade the breakout of that level. Now, if you recall, flat levels are defined by a minimum of 2 prior touches by price at a very specific price point. The more touches, the better. We prefer to see at least 3 touches. I think in most trading situations, you'll find that the market will give you that more often than not. So more touches at a specific price level just confirms better support, better resistance at that level. And the momentum breakout strategy then is really harnessing the power of this principle, trading the breakout. So this strategy gives us a defensive position for our stop loss, gives us a clear and precise entry point for the trade, and then also provides us multiple targets, profit targets, based on the price action that we're trading. Now here's an example of a model breakout pattern that I'd like to show you. The ideal breakout will again have those 2 or 3 touches at a specific price point, which gives us our true support or resistance level. Sometimes you'll get some longer consolidations at the flat level. You might see 3 to 5 touches before the break. And it's a very good sign if you actually get a consolidation of small candles trending up into a flat level like you see here. In this one, this usually signals that a breakout is imminent. So you'll also notice a solid trending pattern on many of these breakout consolidations where price action is actually trending up into the flat level, like with higher lows going up into the flat level. If it was a downtrend, it would be lower highs trending down into a flat level, looking to break lower, going with the predominant trend. But in any event, this breakout example here, price has moved up to this 1.5 level on 2 occasions now, and it fails to break through. So we then have this level defined as our flat level, as our key resistance level. Price then moves up a 3rd time to test this level, and instead of pulling back again to put in a significant higher low, it actually starts consolidating right up against that flat level with a series of very small candles just ahead of that breakout. Okay, so this is a very good sign when you start seeing these small candles like that. That means that the chance of a further pullback to some of these levels here is less probable. It can still happen, but it's much less probable. Instead, this tight consolidation here means more than likely you're going to see this type of a breakthrough occurring. Okay, so just a classic sign of that pressure building up for this final breakout of that level. At this point, you'd be placing your order just 1 or 2 ticks or pips above the high of that 1.5 level. And as price then explodes through that resistance level, it takes us into the trade and then goes on to directly hit our profit targets. Now in this example, we have several good places for a stop loss on the trade. We have 3 touches at the flat level, small candles consolidating up into the flat level. Overall, just a great setup. We can utilize the swing low, which is the most conservative stop loss placement. We can utilize the mid-level higher low as a stop placement as well just adds a little bit more risk to the trade, a little bit more risk of getting stopped out. And then here is the most aggressive stop loss with the most risk. And if the market just pulls back a little bit, you can very easily get stopped out. But since you're so close, you don't lose as much as if you're down here and you get stopped out. But when you're starting out, I recommend people use the swing low because you can get a lot of oscillations in here. And until you really kind of master these, it's good to start using the swing lows, and that just gives you a little bit more room to breathe. I got a question here. They just came in. Is this being recorded? Good question. Yes, it is. I didn't talk about that. We do record each of the sessions. So within 24 hours after the session, you'll have a link, and you'll be getting the recording with all the video and all the voice and everything related to that. So you can review this as many times as you need. Okay. All right, so here are the rules to trading breakout patterns. Okay, we don't trade breakouts of sloping levels. We talked about that, remember? Sloping levels just don't provide us a true support or a true resistance level in terms of a specific price point. Okay, sloping levels just tend to be very subjective. They're typically weak forms of support and resistance. And again, they just don't offer an exact price level for us to predict our entry and our stop locations, and then not even our profit targets. So when sloping levels are broken through, also they don't act as support or resistance, which we actually need that to help us protect our stop loss. Breakout rule number 2, we're looking for perfect breakout patterns. Okay, flat levels must have at least 2 touches to be considered true support or true resistance. The more touches you have, the better, preferably 3 if you can get it. It's also preferable for price to consolidate into the flat level with some small candles just prior to breakout. Here's another example of a classic breakout going short. We have a nice downtrend established here, 4 touch points along the support level and small candles developing right, pressing up into that support level, and then trending directly into that level just ahead of an imminent breakout. So we would set up our sell order in advance, essentially after, basically after the second touch or even after the third touch. And we're just basically going to be a couple of ticks just below the lowest point of that flat level and just waiting for price to explode through that level to actually take us into the trade with a sell stop order with our stop loss above the swing high or the lower high right there. Okay, so we're looking for, so we have our stop loss defined, say here, our entry is here, so all we need is that same distance to travel from the breakout level to, say, this level right here, and that gets us directly to break even as we dump, half of our trade, and we leave our stop loss in the same place. The trade is now at break even, and he rallies back up. Takes a lot of pressure off of the trader psychologically when you have the trade at break even, because there's no risk of loss. So you have profit on the table, but at that point you're playing with the market's money. So as price continues to move down, we can just take that first profit target, do a standard deviation once again, put that down here would be our second profit target, and then right before the rally, we probably get out of our second position, which might be selling the remaining half of that position, which is basically leaves us with a fourth of our original position. We get a little bit of rally, then another sell-off again, and more than likely we hit our final profit target there, and we're out of the trade completely. Okay, so that's how we would manage the trade to the break-even principle. We'll talk about that a little bit more, but those are some real key principles in understanding how to manage the trade. Question here, is there a guideline with the touches, or is it an exact number? A lot of times the touches right here on the flat level, it's going to be very exact, like within 1 or 2 pips. Okay, so sometimes you might have it within 3 to 5 pips, like right here. It might have punched down through that level by a couple of more ticks, but then as going through, it starts to establish itself at a very precise level, and you want these to be very precise. So if there's, a poke through here and a poke through here and a poke through here, that's not going to be, really precise. Okay, like right here, this isn't a flat level because we're actually getting, lower lows as we go through here. These right here are pretty precise. But again, as you can see, the market rallies and then it comes down, breaks through that level. So it's not a setup like this. This is a whole series of candles that are not they're not mistakable, as you can see. Yeah. Okay. All right. So moving right along. Now, remember we talked about indicator convergence a bit last week. This is one of the crucial ingredients that makes this trade setup work. So we need both indicators, the MACD and the RSI, converging as price breaks out to a new high or down to a new low. And this means as price makes new highs or new lows, the indicators do the exact same thing. Okay, so if the indicators are doing the opposite of the price action highs and lows, then this is going to be considered indicator divergence. And you don't want to be taking the breakout trade at this point of indicator divergence. Okay, so spotting indicator convergence is going to come with some experience on your part. You'll have to log some screen time, look at enough charts to begin to understand how to predict convergence before it actually occurs. More often than not, you'll be looking for indicator convergence again before it's actually happened. So the idea here is that as price is about to break out, the indicators should appear to be about ready to do the exact same thing. Let me take a question here. At what point would you set up a trade order if this were in a 5-minute time frame, or is it better to only set up orders on a long-term reader? No, I mean, these are universal trading strategies. So these chart setups will set up on any time frame that you're looking at: monthly, weekly, 4-hour, the 2-hour, the 1-hour, the 30-minute, the 5-minute, the 2-minute, the 1-minute, the 2-minute. So again, you can set these up. It's the duration of the time frame that you're on is going to dictate the duration of your trade. So if you find the setup on a 1 and a 2-minute chart, you're only going to be in that trade for a matter of minutes. If you find it on a weekly and a monthly chart, you're likely to be in that trade for months, potentially, a year, if it's something like a monthly chart. So at the point that you set up the trade is just as I demonstrated at the flat level. Once you have 2 touches, then you have your flat level established. Now you're beginning to set up your entry point with your stop loss, and you're going to set up your profit targets all in the form of an OCO type of order, where if you're triggered into the trade, then the software automatically sets up your stop loss and your profit targets. If you're never triggered into the trade, then the software doesn't do anything. Okay, so we're actually waiting for price action to break the flat level to take us into the trade. We're not buying ahead of the breakout, anticipating the breakout. It's only if price breaks the level are we then taken into the trade. So you have to learn on your on your software, your trading software, how to set up those OSO orders. Okay. Now, just to refresh your memory on convergence, here's an example of a flat level setup where the indicators are converging or have just pulled back slightly. If the indicators have pulled back, then you just have to eyeball the price and the indicators then to determine if a break of the flat level is going to send the indicators to a new high. So this is a fairly common thing and usually resembles some of the better breakout examples. If you're confused about this concept, you'll want to spend some time looking at diverging indicators, the opposite, where price action is actually doing the opposite of what the indicators are doing, and then I think you'll get a better feel for it. But just to walk you through this, here's the MACD, here is the RSI indicator, and as you can see, price action is making higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, and so forth. And we have the indicators just looking at the tops doing the same thing, making higher highs And then as the price goes flat, the indicator goes flat too. So these indicators are really just mimicking the price action. You can see here on the RSI, everything is going higher high, higher high, higher high, higher high. Okay, and as price goes flat or dips down, the indicator does the same thing. It's just mimicking the price action. There are no higher highs here, and so it's putting in basically lower highs essentially, or kind of a flat level, if you will. And then as we punch up to a new high, then we kind of get at least, maybe not a higher high, but we get at least an equal high, which is okay for our intents and purposes. And then as we get another high, we get almost kind of a slightly higher high or an equal high. And then as we get a higher high, we get looks like a definite higher high at that point, and then a definite higher high at this point once we get through that flat level consolidation. So whenever you see the convergence of both of the indicators along with price, that means we're in a strong trend. And then as we get into some of these other levels out here, you might start to see, like another higher high here or a retest of this level up here. I can tell you that this is more than likely going to put in a lower high on the indicators. And at that point, we're going to have probably some serious divergence at that point, and I would be expecting probably a deeper pullback and then probably a resumption of the uptrend. So that's kind of how we're looking at these breakout patterns. We're converging, we're really strong on the trend all the way up to this flat level, and then that's when we get the breakout. If we're diverging ahead of this breakout, we do not want to be looking at this trend setup. So you'll see plenty of trading opportunities like these on breakout patterns. Here we have our flat level with 3 touches at our level of resistance. The indicators have pulled back somewhat, not necessarily diverging, since we would need another higher high in place, right? And that would then give us basically a lower high. But the consolidation of these patterns right here, sometimes they're going to pull back a little bit off the high, and they're just going to mimic the price action going flat for a period right here. And that's kind of what we're looking at. And so the challenge here, and this is really imperative to understanding this, otherwise you're going to miss out on a lot of trades. We've got 3 touches. We've got small candles right here. We got everything fanning out. We have a swing low. We have a higher low, a higher low, a higher low, all trending up into this level. Okay, and then what we have to decide at this point is if price does break through this level, are we going to put in a higher high at this point? And that's really going to be, the crux of the matter. If we can't see a higher high being put in place on the indicators, then more than likely if it puts in some very strong divergence on a breakout of this level, then that's going to be a reversal, and price will then shoot up, break down, and then break down through the swing low, and that's going to show up in a lot of divergence. So on something like this, it's just going to take some practice in looking at ones like this. I mean, for me, I would probably look for a little better setup than this one, unless I got a whole series of smaller candles consolidating here. If I got small candles consolidating here, more than likely you'd see these, the MACD and the RSI starting to trend upwards and getting closer to the most recent high. And then by the time we get a breakout, then I could actually visualize the indicators breaking out to new highs, or at least breaking out to equal highs, which is just as good. So I want to be careful on ones like this. If this was a flat level and this line was a little higher up above here, then on a breakout I could actually see that line moving up to a new high. I'd feel a lot more comfortable getting into this trade. But the way it's set up here, I'd kind of look for something a little bit better, unless I got a lot of those small candles pressing up against that level, and I had on maybe successive higher time frames than what we're looking at here, I had some nice strong uptrends on the charts. That would then give me a lot of confidence that more than likely price is just going to blow through this level, and it's going to keep on going. And more than likely price, if it is diverging, it's just going to continue to diverge and diverge and diverge. simply because the monthly, the weekly, the daily charts, all the hourly charts are all in a strong uptrend, and the market is just really screaming higher. So a couple ways to look at that, and as you just look at more charts, you're going to understand how to actually read the price action and understand the momentum that exists in the markets. Let me take a couple of questions here real quick. Question here, if I understand you right, you don't set up after the touches, but actually wait until the actual breakthrough starts. No, that's incorrect. We are actually, right as soon as we get 2 touches, we're getting our trade set up at this point, and we're setting it up just a few ticks above the high of the flat level. At this case, it'd be a few ticks above the high at this point. So it'd be somewhere right up around here would be our buy stop order. So we're not doing a market order. We're doing what's called a buy stop. A buy stop means that the order is just going to sit here until price actually breaks through the order level or the price level of our order entry. Okay, so say we're setting up here right around 1286, and that's going to be our entry. Then until price breaks through 1286, that order is just going to sit there and it's not going to do anything. We're not actually in the market. We just have an active order sitting there. So the active order is going to contain a buy stop order right here at 1286. It's also going to contain a stop loss order right here. And then the difference between our stop loss and our entry is going to be our risk. And so that's going to define our first profit target right here, which will also be part of the order. And then another standard deviation for profit target number 2 and profit target number 3, all going to be wrapped up in one single order. So once you set up your order, if you can just walk away from your computer and the trade servers will handle it for you. So as price breaks through, you're taken into the trade, and then the software automatically puts in your stop loss and automatically puts in your 3 profit targets. Okay, and that's the way you want to set up your trades. You don't want to do this stuff manually and wait for the breakthrough and then try to catch it at a market order. That's when it breaks through, it's going to explode with one large candle, and the market action is going to be a frenzy, and you're just going to be chasing it. You probably won't get into it until it's way up here. So you have to be set up in advance, okay? Another question, are these some of the stronger patterns to look for to set up swing trades, or are there other pattern entries? These are for day trades. These setups are for swing trades. They're also for long-term investing. So it only depends. The only thing that determines a swing trade from a day trade is the time frame that you're on. Okay, a swing trade is going to be something, in the hourly time frames. Day trades are going to be something, below the 1 hour chart. A 60-minute, 30-minute, 15, 5-minute, 2-minute, 1-minute, that's going to be a day trade. Longer term trades are going to be on investment trades, are going to be on the monthly and the weekly charts and the daily charts. So that's kind of how you can break down whether you want to look for longer term investment trades or whether you want to be short term intraday or somewhere in between. These, could you show us examples of live trades? This is a live trade. So what you're looking at is I'm actually calling the trade, and this is a picture of the trade setting up. It's not going to get any more live than this. If you want to see actual live trades, we're doing Nadex live trading every Tuesday. So you can check into that. We're actually going through the charts, and we're looking for these exact scenarios right here. But this is about as good as it's going to go. If you can't see the trade setting up here, you're never going to be able to see it when the market's moving quickly in live price action, okay? All right, so moving ahead, working with multiple time frames gives us additional confirmation since we are looking at the same price action represented in 2 or more different time frames, which provides us, again, just another view into what may be happening in the markets. So let's take a look. All right, so looking at the same trend in another time frame is really just another ingredient, right? And this helps to improve the probability of a successful trading outcome. So it provides us with some additional information, possibly a bigger picture view as to what, may be a longer term move in the market. A trade set up on, say, a 60 and 120-minute chart is going to have a longer trade duration than, say, a 2 and a 5-minute chart setup. But even when we're trading the higher time frames, we still want to time our entry with some of the lower level charts to get as precise as we can if that's possible. So it just makes logical sense if we identify a trade setup on the 60-minute and the 120-minute charts to then also check the higher time frames like the 240, the 480, and even the daily chart. If we find that a higher time frame confirms the setup on the lower time frames, or at least confirms the trend, now we have 3 charts confirming that move that we're looking at, or maybe even more. It could be 4 charts confirming the move. Okay, so the higher time frame really provides us with the bigger picture view as to what's really going on in the market. Is this just a pullback in a downtrend, or is this really, a setup for the market to move higher? On the higher time frames, we'll also notice key levels of support and resistance that will provide good clues as to the levels we should be buying or selling at when we find a trade setup that meets our criteria. So this will translate into better stop loss protection, better target identification for our trades. For example, placing stops protected by major levels of support and resistance, placing our targets, our profit targets, just ahead of those major levels of support and resistance. Higher time frames really help to optimize our trading setups and where we place our stop losses and our profit targets as well. It just gives us another piece of information to go with. So having agreement then from more than one time frame, again, just adds another reason for us to take the trade, and then gives us a number of other scenarios on our setup. Okay. So what we're looking at here in this table is the order of the time frames and where the setup is occurring. And what I mean by that is if the trade is setting up on, say, the 15-minute chart, then that is going to be called our precision chart. Okay, what that means is the trade is best defined on this time frame. Okay, the next time frame above the trigger chart, P, is called the confirmation chart, P1, or in this case, the 60-minute chart. So these are just some examples of the chart pairings in this table that you can look at, but get in the habit of looking across a whole series of time frames to find your high probability setups. So more than likely, in reality, I'd be looking at a trigger chart on the 15 and a confirmation chart of the 30-minute, and then I'd also be looking at the hourly chart to make sure that I'm getting the direction right and that all charts are flowing in the same direction, and that the 60-minute confirms, say, the trend. Here I'd be looking at the 1 hour and the 2 hour, and then potentially the 4 hour as my anchor chart. Here it'd be, the 4 hour, the 8 hour, and then the daily as my anchor chart. So you can use them as they're set up here, or I like to go a little bit closer. It just gives me, it just makes me feel a little bit more fine-tuned when I'm looking at the 15, the 30, and the 60, and then I'd probably even go to the 2 hour and see how that group of 4 charts looks. And if everything is trending up or everything is trending down, then I can better identify my setup and understand, the longevity potentially of, that trade. And then I'm also looking at the monthly, the weekly, and the daily to see what the overall longer term trend is. I mean, is this a setup that's going to run for, a number of days or a number of weeks? Potentially it could, and then I'm just looking at some of the lower time frames to figure out a good entry point for that for that next run. Let's take a look at some examples of multiple time frames here to see how this applies to what we're doing. Here we have a daily and a 240-minute chart, and both are trending very nicely to the downside, as you can see. In looking at the 2 chart structures, we can see that the daily chart has some nice smooth flowing lines that we can see. Moving averages are fanning out to the downside very nicely. Price action pullbacks into the sell zone very nicely. If we had that 10-20 period moving average, that would just be flowing right along here. Same here, that 10-20 would be flowing right along here, where we have those rallies right back into the sell zone, setting up those lower highs that are trending down into lower lows. On the 240-minute chart right here, we have that same exact trend. It just looks a little bit different because of the shorter time frame, and we can actually see the rallies a little bit better. Here, if we were taking a trade and getting into the short here, then we would have this long ride on the daily chart. To figure out where to pick up that trend, we can go down to a lower time frame like the 240. We have some small consolidations in here where we can pick up that trend to take the market down further if we happen to miss this trend on this one on the higher time frame. So setups on the higher time frame, once they get started, then you can start to look to the lower time frames to engage that longer term trend, because this one's set up, it took, on a daily chart, it took 1, 2, 3, 4, 5, 6, 7, 8 days to set up. Once it broke, it went for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. Literally went for almost 3 weeks to a month if you consider this is, 5 trading days a week. So once you get these setups, even on daily charts, in a really strong down market where all the charts are aligned on the higher time frames, the monthly, the weekly, the daily, setups like this can really run a long time. So that's how we want to be looking at things. So higher time frames, once again, are going to help you to stay focused on the bigger picture and help you to stay in trades potentially longer as well, which is going to be helpful. So really learning how to use multiple time frames can help you, as you can see. Now, these are 2 good examples of charts that are telling a little different story. On the daily chart, right here we have a smooth flowing structure, lower highs, lower lows, good moving average lines, all fanning out, good downtrend. But on the 240-minute chart, can you see the difference? The price action looks very, very erratic. We have big candles, we have moving averages are out of alignment, we have wild swings in price that are very unpredictable. So the only thing that a chart like this tells me is the price action is not as predictable as I would like it to be. I don't want to risk money on an unpredictable chart. I just want to move to the sidelines, conserve my cash, and wait for a better setup. So when you see types of charts like this, they're very obvious. You can tell right away that something is wrong. It's just time to move on to the next chart, look for a better structure. So what I would do in this case is if we have, a nice trend on the daily chart, then I would go and I would look at, instead of the 4-hour chart, the 240-minute, I would look at the 8-hour chart and see if I can find a setup on the 8-hour and the daily. And then also look at the weekly and the monthly. And if everything is flowing to the downside on the weekly and the monthly, then more than likely this is going to be a good setup in the sell zone. If I can get, 2 charts like the daily and the 8-hour with, 2 candles in the sell zone right here, then more than likely that's going to be a high probability trade going to the downside, because I've got the weekly and the monthly also trending to the downside as well. Okay? So that's how that works. This only means that we don't have a trade setup on this particular chart. So that means that we either need to go more than likely higher. I wouldn't necessarily go lower than this because I want to get out of all this chop and I want to get to a bigger picture view of what's really happening. And so the higher time frames in that case help me to do that. Now, can you see the difference between multiple time frames in alignment? Okay, both trending to the upside very nicely. Moving averages are in order, fanning out on both charts, precise pullbacks to the buy zone on both charts. Okay, the key to multiple time frames is that the information should be obvious. If there's any confusion about the trend or about the moving averages, you just need to pack it in and move on to the next chart. Okay, but here we can see historically these pullbacks are coming back into and in and around that buy zone very consistently and then taking off. Here was basically just kind of a straight across consolidation with the moving averages catching up. Nice bullish candle there in the zone, and then we took off again. As you go down to the 60, same thing, except as you move down in the time frames, you tend to get the pullbacks are below that level. So instead of looking at the 60-minute, I'd probably move up to the 120-minute and look for my trade on the 240 and the 120. And as you move up, you'll find that the price in the zone is going to move up higher, and you're not going to have all these crisscrosses of the moving averages. Okay, but in any event, even here we've got all the moving averages in alignment, flowing to the upside. Uh, right here we had the moving averages were touching when we had this set up way back here, but they really never did cross over as the market broke up. They just they broke back up and started to separate again, and now 50, the 20, and the 10 are all fanning out again. So if you put the 120 in the middle of these, you basically will have a setup across 3 time frames. Throw in the 8-hour chart, and all of a sudden you've got a whole series of charts giving you a pretty good high probability structure there to trade off of. Another question here that I can respond to, how closely do short-term trades follow the long-term time frame trends? For example, for short-term trades, should we focus more on the localized indicators that we talked about, convergence, touches, etc., or should we give a lot of weight to differences in the long-term charts? The best way I can answer that, it's going to take some experience, but the best way I can answer that is if you're trading short-term, meaning intraday, then your chart setup, your time frames should be the 60-minute, the 30-minute, the 15, the 5, the 2, and the 1, and that will be your intraday setup with basically the 1-hour chart being kind of your anchor chart. I would look at the daily chart as well to see which way the daily chart is trending. But those would be the time frames I'd be looking at. If you're looking for swing trades of like 3 to 5 days, then you'll be looking at probably a 60-minute all the way up to like an 8-hour or a daily chart. And then if you're looking for longer term investments, it's really going to be the monthly, the weekly, the daily, and even potentially the 8-hour. So those are going to be the three in terms of long-term investing, swing trading, and intraday. Does that help you, Rada? Okay, so on this particular chart, obviously the the trade has already taken off, so we already have a lot of overextension from moving averages. We don't want to be chasing the green candles at this point. We want to wait for the next pullback into the buy zone, and we're just biding our time. This market can keep going up, but you know what? I'm not going to jump in and I'm not going to chase these candles. I'm going to wait for that pullback, and I'm going to get my setup, and then I'm going to get long because there could be a lot of things that change in the time that the market's ramping up here. So we want to going to happen is price is going to snap back to the average because that's the average price at this point based on the price action of this trend. Okay. Let's see. So Leah's asking, how do you identify fake outs? Well, it's really about looking for those reversal patterns. It's really about paying attention to the divergence of, say, an uptrend or a downtrend even. That's going to tell you that the trend is weakening. On the trend flow trade like this one, you can trade this one with some slight divergence on the indicators, but you do not want any divergence on the momentum breakout trade. Okay, so you only want to trade flat level breakouts with convergence. Any divergence, and you just want to back off the trade. This one here, you'll see the markets continue to move higher, and they'll continue to diverge for probably 1, 2, or 3 legs of divergence, meaning, a lower high, lower high, lower high, and then you'll see the markets pull back, and you'll see that divergence across multiple time frames. Okay, so once you start to understand price action, understand the chart setups, you'll start to see that divergence occur across multiple time frames. When you get divergence like this on an upward trend, and I start to see divergence across, 2 and 3 charts, even 4 charts, that's when I'm going to start to, back off of my long trades. I'm going to wait for the market to pull back on a higher time frame. Like in this case, if there was divergence, I'd look for a pullback then potentially on the daily chart, pull back into the buy zone, and then I'd start to get set up to, continue the uptrend again. So that's really going to be about log in a lot of screen time, mastering trends, mastering price action, and always looking to the higher time frame to guide you. Okay. Another question here: does Nadex allow for the type of entry setups that you mentioned? Nadex is going to be slightly different. As you know, you can, and I don't think I'm out of line saying this, but I believe they've changed the setup where I believe you can place a buy stop order instead of just a limit order in the price action, which will allow you to take advantage of the way that I'm describing these scenarios. The only thing that doesn't apply would be putting in a stop loss, because obviously with Nadex, you don't need a stop loss because that's built into the contract. But the reason I describe utilizing a stop loss is because if you don't know what your stop loss is going to be in the price action, then you have no way of determining where your target levels are. So even though we're not using a stop loss with Nadex contracts, we still want to understand what our risk is. We want to understand where we would put a stop loss, because that's going to calculate our profit targets for us, right? So with something like Nadex, I could put a buy stop order. It would take me in. More than likely with their trading platform, I would have to put in my profit targets probably manually, but I can still do that once I'm taken into the trade. I know what my risk level is. Say the binary is sitting here at 25, or it's sitting here right at 25 at the breakout of these levels. I enter at 25. The stop level here, might be, something like around, I don't know, 20 or 15. So it's roughly about 10 points. You'll just have to guesstimate that with some of the binaries. But you'll have an idea based on when the market touches those levels, and you just have to watch it and look for, the movement of the high and the low between the swing low here and the touch of the high at that level. And then you'll be able to make that adjustment. So if there's if you have a 25 and a 10-point swing, then you'll be looking to unload half of your position at 25 to say 50. And then potentially at 75, and then at 100. And that's going to be different based on the time value that's left in the contract in the binary. So with an option, obviously it's going to be a little bit different. But the one thing with binaries that you want to do is you want to get the trade to break even as quickly as possible, because these contracts can go to zero, and they do it often. So you want to make sure that you protect yourself from with break-even type trades. All right, so another question here. For example, on this chart, when you see a strong uptrend, is there any way to determine when the pullback would start other than experience? Well, I mean, on this one right here, I mean, there's, the price is overextended from the moving average. So all I can tell right now on these time frames is that I'm not interested in trading these time frames. What I can do is I can go down to a lower chart like the 15-minute, the 5, the 2, and the 1, and you're going to have, some buy signals in the buy zone because it's on a lower time frame, and you'll see those charts in a very strong trend. So if price has already taken off and you think it's going to be, a longer ride, then I would just go down to the 30-minute, the 15, the 5-minute, the 2-minute, and see if I can find an entry there. And then I have to manage that trade based on the lower time frame. Does that make sense to you? So that's how I would do that. Okay, moving right along, reward versus risk, very important. This is our final ingredient before we bring in the strategy or that recipe and pull it all together. So as traders, we are constantly exposing ourselves to manageable risk. That is the risk of losing our capital. We have to accept this as traders. That's just part of the deal. We continue to do this because there is a payoff that is potentially greater than the risk that we're taking. So we risk our capital for the potential to make the same or more than what we risk. This is the reward for assuming that risk. Many people who trade the markets, they kind of miss this concept. Risk is an extremely important part of trading. So the responsibility that we have as traders is, to ensure that the potential sum of our winning trades is greater than the sum of our losing trades. And so, notice that I'm saying the sum of your trades and not the number of trades, because you could effectively only be right maybe 50% of the time. But by utilizing proper risk management, you could actually be profitable at only being right half the time, because you've set up the trade in accordance to the strategy, and the strategy is what gives us that advantage. So I get this question a lot. People ask, do I need to use stops with Nadex contracts? We already talked about that a little bit. Limited risk is an integrated part of the Nadex contract in certain circumstances. In underlying markets, actually in all circumstances in underlying markets, you would use a stop loss. But with a Nadex contract, the stop loss is built in, so we're determining in advance how much we want to risk on the trade, and there's no stop loss involved. If you've got $100 risk on the table, you're only looking to risk $100. It's basically you would only buy that amount of contracts, Nadex contracts, that adds up to the $100. Where in the underlying market, you would actually put in a stop loss that would equate to $100, and that would be your stop. With the Nadex contract, the market can go against you for eternity, and you're only risking what you've put into the trade. Okay, so managing that risk makes it much easier with Nadex contracts, because it's built into the contract, and you can't lose more than what you put into the trade. So it's really just about understanding how much you're looking to put at risk, and that's going to be your defining characteristic of your risk management component. So we've talked about this before in previous webinars regarding risk management and Nadex contracts. Here we have an order ticket that displays the maximum risk per trade at your specified price. If you have decided on a maximum risk amount per trade, such as 1% of your total value, or in this example, say $300, then you can use the order ticket to change the position size or the number of contracts until the total maximum loss is closer to your risk tolerance. Okay, so if it's $50, then you're going to be trading one contract. If your tolerance is upward toward $300, then you can trade as much as 6 contracts. If you're in between, say it's $150, then you're looking probably at 3 contracts. So the order ticket makes it very easy by looking at this box down here to determine, where you're at in terms of how much cash you want to put at risk. Managing risk when trading call spreads can be done simply by buying the call spread near its floor or selling the call spread near the ceiling price. What this does is this leverages the floor and the ceiling limits of the contract to provide a built-in stop loss for your trade. Okay, in a little different example, say you're trading a call spread in the middle of the floor or ceiling zone, as in the case of this second order ticket, then it makes sense to use a traditional stop in the form of a limit order to define your maximum risk, and you can do it that way. But that exists on the on the spreads. Now, throughout our discussion of trade strategy, I've been talking about setting a stop loss or defining the risk on each trade as a part of the trade criteria. And that simply means that we are using the price action on each trade setup to determine if a valid trade entry is worth the risk. Sometimes there may be a great trade setup, but there's something about the price action that puts your stop loss just too far away, and you may decide that it's just not worth the risk, and you'll instead wait on another trade setup that looks better. So just remembering that the further away your stop is, the further away your profit target has to be also. Since we're going to be working on a one-to-one reward to risk principle, simply means that a 20-point risk means a 20-point first target at a minimum. You can't take a 20-point risk and all of a sudden be cashing out at just 10 points when you get into a little bit of profit. If you do that enough times, you're going to have an extremely high win rate in order to make any money. But if you're always working on 1-to-1, 2-to-1, 3-to-1, then for every dollar you risk, you're always making, at least $1, if not $1.50, $2, $2.50, or $3 on a trade. And that way, you can even be break even on your win-loss ratio, but you're still making money. So in this momentum breakout example, we're measuring the stop loss and defining this point as the key level when we're actually wrong on this trade. And that key level is going to be when the price action breaks the swing low. Okay, so say we get taken into this trade on the breakout. You didn't notice that there was some divergence on the charts, and there was, and you missed it. And so all of a sudden it breaks up through, and then it reverses and it comes down and hits our stop on, say, an underlying market trade. We want to be out of the market on this trade, and that stop loss would occur at the breakdown of this trend where we have higher lows trending up. We no longer have a higher low. We have now broken down to a lower low below this swing low. Okay, so the trend is now broken. We want to be out of the trade because the reason we entered no longer exists. So it's really imperative, even when trading Nadex contracts, make sure you're calculating your risk. Make sure you're understanding the swing low position in an uptrend, the swing high position in a downtrend. It's just going to create good trading habits for you, okay? Now, we'll always have to make choices when it comes to stops with the momentum breakout strategy. On any given trade, there will be several sensible places for a stop loss, keeping in mind that the closer your stop is to your entry, the more likely it is to be hit. And in this trade, we have 3 sensible locations for our stop. The swing low is the higher probability stop. Then there's a mid location, and then a very aggressive stop location that I have detailed here on this chart. So the swing low is going to be obviously the higher probability stop loss. It's going to be most difficult to be stopped out here. Then there's the midpoint location, which if the market can pull back a little bit, you can potentially get stopped out here. And then this one is going to be the most aggressive. And, there is a higher probability of getting stopped out if you're putting your stop this close to the entry level. So that's, and each one of them has its benefits and its downsides. And so you just have to get used to, deciding that for yourself, how much you want to risk and what kind of a person you are related to all that. Okay. And then also you have to, manage the number of contracts that you're trading to reduce your total maximum exposure. And that'll get you on the right road to getting a good trade setup going for yourself. So again, the best place for stops, always at the swing low in an uptrend or the swing high in a downtrend. So in the trend flow strategy, we are locating a reversal candle to utilize the high of that setup candle as our entry point and the low of that candle as our stop loss. Sometimes the candle setup, it's not always this clean. You might have several candles here in the zone, small candles. So the idea is to locate the stop below the swing low within that trend like we're looking at here. So again, this is going to be the point where if price breaks lower, then the trend change is most likely going to occur at this level right here. Okay. Let me take a question here. For example, when you are trading a trend, not necessarily a breakthrough, is there any, say, set rule that when the price action gets a certain distance from the moving average, it usually triggers a pullback? No, it just what you want to do is you want to utilize the multiple time frames to do that. You want to stay with. You'll find that when markets move up and they get overextended, you will tend to find very small indecisive candles with a lot of overextension from the moving averages. That can usually tell you that if price breaks through the bottom of that, more than likely it's coming down for another pullback. And then you can also look at previous runs. If the candles have been, 8 to 10 on the run and then, 4 to 6 on the pullback, a lot of times it'll repeat the same thing and it'll create this stair-stepping pattern in the price action. And you can look for those sometimes those kind of things as well. That'll kind of help you. But I'm running a little low on time here, and so I'm going to have to pick up the pace a little bit to get to the finish here by the end of the bottom of the hour. Let's go ahead, let's put everything together now with all the ingredients that we've learned so far in the first two sessions, understand really how to do this in real time, and show you guys how we work through the charts. Here's a running list of our rules for the momentum strategy. We're trading breakouts of flat horizontal levels. We're only taking those breakouts going in the direction of the predominant trend, looking for convergence on the break between price and the indicators. The MACD and the RSI, that means if price is breaking to new highs, want to see the same thing happening in the indicators. If price is making new lows, then the indicators should follow suit as well. So we want strong price action support, protecting our stop loss position. We want to play some strong defense here. We want to protect our stop, want to manage that risk. Okay, with Nadex contracts, that's going to be built into the contract, but you still need to understand where your stop loss would be in order to calculate your risk on the trade to figure out your profit targets. Okay, we're only going to risk, say, a maximum of 1 or 2% of our trading capital on each trade. Make money slowly in the markets. If you're making money too fast, chances are pretty good that you're taking too much risk. Here are some of the bonus factors, which are in addition to the required ingredients. So bonus factors are not required for the trade setup, but they will improve the reliability of the trade setup that you're looking at. The idea, once again, is to layer as many technical reasons as possible to gain confidence that this is a high probability trade. So for the momentum breakout strategy, here are the bonus factors. The moving averages, I know we already talked about this one, but what I'm saying here is that this is a similar way of using moving averages from the trend flow strategy that we can also use with the momentum breakout strategy. So at the breakout level, that flat level, we can look for price to be in or around the buy-sell zone, that 10-20 period moving average zone. The correct moving average geometry that we use to define a strong trend is still going to be a basic requirement. But here we're talking about price being in the buy-sell zone just ahead of a breakout. That usually would equate to small candles consolidating just ahead of that flat level. And there would be a bullish candle in the buy zone just ahead of a breakout, which means you almost have a combination momentum breakout strategy as well as a trend flow strategy all wrapped up in the same trade, and your basically price is right at the flat level and it's ready to move higher. So great bonus ones when you have combined strategies working together like that, very powerful. The next bonus one, number 2, is candlesticks. Are the candles consolidating just ahead of that breakout level? Are there nice small candles in the consolidation zone pressing up on that flat level or pressing down on that flat level just prior to breakout, trending up into that flat level in the buy-sell zone? That's usually what happens with a lot of those candles. Basically sets up that combination momentum breakout and trend flow strategy all within the same chart structure. Very, very powerful move. Number 3, the indicators. Check to see that the indicators will not diverge on the breakout as you are taking your entry. This is a very important one. We can accept flat indicators, but we do not want to trade in the direction of strong indicator divergence. This can be a very strong signal that price is about ready to break out and then reverse, and you're going to get what's called a fake breakout or a false breakout. The last one, multiple time frames. If the trend is consistent on higher time frames, this will improve the probability as well. Make sure to check the higher time frames to see that you are not trading against the predominant higher time frame trend. This can be a very easy thing to do. It kind of feels like you're swimming against the tide, so not a good thing. Okay, this is a screenshot, should be familiar. This was the first momentum breakout example that I showed you in part 1 last week. We looked at it again at the beginning of this session. So I want to just kind of walk through this one with you. First thing that we're looking at is, do we have a trend? Looks like we have a reversal pattern setting up with divergence on the indicators. So we have a basically a higher high, and a higher high, and all of a sudden we have basically with this higher high right here, we've actually put in just a slight lower high from the previous one, and then the higher high here is definitely a much lower high in this case. And you get the same thing here on the RSI. Very easy to see here that price action is trending this way, and the RSI indicators are trending downward, which is the opposite. And that is really the epitome of divergence. Okay, so we have that rollover complete, a couple legs of divergence, meaning that this uptrend is a little bit long in the tooth, it's weakening, and so all of a sudden it does what we think it's going to do. It rolls over, it actually breaks the swing low, and then bounces up, puts in a lower high, and then rolls over again. So now we have from a higher high to a lower low. That signals us to a head and shoulders pattern, which we have the left shoulder developed right here. We have the head, and now we've actually created the right shoulder, and we have the neckline created with these two pieces right here. So we have a lot of things forming here just by looking at the price action. Now we have a flat level setting up right here with two touches. Moving averages are in order, 50, 20, and the 10. Small candles consolidating. Looks like we're going to be breaking down to a lower low. And so that's how I would be looking at a trend like this. When you get a lot of experience, you're going to be able to pull all of that together very, very quickly. And that's really what it means to master price action. Okay, you can take away all the moving averages, and I can just trade this setup based on the pure price action alone. Because I basically know when the market's trending up, I know where the moving averages are going to be. When the market's trending down, I know where the 10 and 20 is going to be. It's where those pullbacks and those rallies are going to occur and where the sell-offs occur. I can look at the flat levels and determine, pretty closely, where the moving averages might be in that regard. So we're really just using some of these other components as just additional factors that we can utilize. Okay, so great opportunity there for a trade setup. First thing you'll want to do to master this strategy is to write out a checklist in your own words of the ingredients required for the momentum breakout strategies. Will give you a systematic way of analyzing your trades step by step. Add in the bonus factors as separate section to that checklist, because you don't need to have the bonus factors in order to take a trade setup, right? It just adds to the fundamentals of what we're doing here. So this will become the basis of your trading plan for this strategy. Go ahead, snap a screenshot of this by pressing the print screen button and save this, or you can just get the recording when it comes out and go through this and do the same thing as well. But you want to go back and review the recording in order to get detail out of the ingredients that are listed here, and you want to make sure that you put together your own notes for for that whole checklist. And that's just going to help you in the long run. So we'll go through these together real quickly. That checklist is going to be about support and resistance, right? You need at least 2 touches at a specific price level. Trends, you need an optimal chart structure with smooth trending price action. Pull back into the support level, no erratic candles. Moving averages have to be in order, the 10, 20, the 50 at least. If you can add the 200, great. All aligned in the same direction, all angled in the same direction, all spaced out, fanning out in the direction of the price action trend. Candles, we want smallish candles throughout the trend that tell us that price is predictable. Indicator convergence, look at the MACD and the RSI converging with price going in the direction of the predominant trend. The reward to risk, we want a minimum of 1-to-1. Reward to risk means we're risking $1 to make at least $1, if not $2 or $3 on the trade, and we're risking no more than 1 or 2% of our account value on each and every trade. Okay, so you want to get that set up for yourself within a quick checklist that you can utilize. So that was the complete momentum strategy, and as you can see, most of the work is in understanding how to use the ingredients. Once you understand the ingredients, putting it all together is fairly simple. Let's go ahead now and do the same thing with that trend flow trade, get you all set up for that one. The trend flow strategy, as with the momentum strategy, we're still looking for a strong trend for the trade, right? We're still looking for confirmation across multiple time frames. We're looking for the same trending type of chart structure that needs to be present with the moving averages in the correct geometrical pattern, similar angles, all the moving averages fanning out, and we want to see the chart structure across a minimum of at least 2 time frames. So all of that is identical with the momentum trade. So you're looking for the same thing. It's just that the setup that takes you into the trade is different. So this entry, again, different from the momentum. In an uptrend, the trend flow trade is defined by a bullish candle in the buy zone after a pullback structure. And we're going to be buying on the next candle as it breaks up through the high of the setup candle. In a downtrend, the entry is defined by a bearish candle in the sell zone after a rally, and we would then sell on the next candle as price breaks down through the low of that setup candle. So we want to make sure that you understand the candle entry. You have to wait for the close of that setup candle in the buy or sell zone. Okay, you have to have the entry completely defined for yourself. So you're actually placing your order as the next candle is forming. So then we go and we place our stop loss behind the higher low in an uptrend or above the lower high in a downtrend to protect it. And then we risk, again, a maximum of 1 or 2% on each trade, regardless of how strong the trend is or how good the trade looks. The bonus factors here to improve the probability of the trend flow trade. Indicator convergence improves the probability of success when you trade with indicator convergence. This was an essential for the momentum trade, but it is not for the trend flow trade. So you still can trade a trend flow setup with some slight indicator divergence. Next one is candlesticks. On some of the better trade setups, the candles should be small as price pulls back into that buy or sell zone. So not just a bullish candle, but a small bullish candle, right? Because remember, this candle is going to define our risk. And we want to make sure that, that our risk is small on these trades. 2 more bonus factors here, support and resistance. A prior support or resistance level is going to improve the success or probability of your trade because the support and resistance level is protecting our stop loss. Okay, so you can look for a combination of things like big numbers. Any number that ends in like 2 or 3 zeros can be a big number. Price action support resistance levels between your entry and your stop loss is always a good thing that just provides some additional support. And even though we're not using a stop loss with Nadex contracts, that still provides price support protection or price support resistance, which is going to, limit the downside in, in your trade when you're trading a Nadex contract. The last bonus factor is multiple time frames. Use higher time frames to confirm your trades. Don't limit yourself to just 2 time frames. The more widespread the confirmation throughout the charts, the more reliable the trade can potentially be. Here's how this works. Let's just go through this live chart setup right here. There's a good downtrend setting up right here. As you can see, we have all the moving averages aligned, the 200, the 20, and the 10 on 2 side-by-side time frames, the 2-hour and the 4-hour. We have a nice rejection candle here after a nice consistent sell-off. We're getting a little rally back up in and around that sell zone, the 10 and the 20 period. We're getting a rejection candle right there. Here on the 2-hour chart, we've got the rally all set up. We've got a little bit of a rejection there. We've got a nice small bearish candle setting up in and around that 10-20 period zone. We just need to have a closeout of that candle, and we can start to get ready for the breakdown below that level for the next move lower. We can easily see in this setup where the price action has rallied before. It's given us a bearish candle, and the sell-off has continued. We've gotten a consolidation straight across, not necessarily a flat level because we don't really have perfect touches here. We do have a perfect touch here and here. So you could say that there are 2 touches and then a breakdown. That would be a flat level. But we also have some nice rejection candles right in and around the sell zone that are actually better setups. And the breakdown of that level gives us the next move. And this is just another rally into the sell zone for another breakdown lower. So overall, pretty good setup there. Nice small candle, minimum amount of risk and we have nice convergence on the indicators, as you can see, lower lows on the MACD and the RSI. Same here, just a slightly lower low than the previous one, but all is good, and we're looking for some continued weakness in the markets and a continued sell-off. So again, to master this strategy, you'll want to write down, again, a checklist in your own words of the ingredients required for this trend flow strategy. This is going to keep you, once again, systematic with your trading. Add in those bonus factors as a separate section, and you'll have 2 trade strategies in your trading plan to, to trade your favorite markets. So I'll just point out some of the differences from the momentum strategy. Indicator convergence. Okay, convergence is not a basic requirement. You can continue to trade a trend with divergence. You just need to be aware of it with the trend flow trade. The candles, again, with the trend flow trade, you have to have a specific bullish or bearish or an indecisive candle setup on this strategy, which, again, those 2 things are different from the momentum strategy. Okay, just wanted to note that for you. So putting it all together, we'll take a look at a couple of trade examples here to give you a better feel for how the strategies work, and then this will wrap up our session for today. We'll go over a few minutes here, but I want to cover these trade examples with you and make sure that you guys get a couple of looks at what these look like. So let's just walk through these together. Here I'm going to give you 3 time frames to look at for this one. We're going to start out with the hourly time frame, and then we'll look at the 240 and the daily on the next slide. So just walking through the 60-minute chart here, we have a good trend set up on the 60-minute chart. Moving averages are fanning out very nicely, all of them, the 200, the 50, the 20, and the 10, higher highs, higher lows. We've got a nice little flat level setting up right here with 1, 2, actually 3 touches. On this one, we have a swing low, we have a higher low trending up, and it looks like we have a nice little rejection candle right there. We'll see if we get multiple small candles consolidating across here for a final breakout. Right here we have a higher high. We have a lot of convergence with the most recent higher high. The market just had a deeper pullback, which the indicators are reflecting that, and now they've begun to trend upward again, and then they've gone basically flat at a level just below the previous high. So the indicators are really just kind of mimicking the price action. There isn't any divergence here or anything. So that looks fairly decent. We've got a level there just above that 92.62 level is what we're looking at. Let's take a look at the next trade setup, the next couple of slides, and see what that looks like. We've got the daily and the 240. So let's walk through this one. Good trends on both the daily as well as the 4-hour. You can see that trend flow trade has been working in the buy zone here, which looks good. As far as the MACD and the RSI on the daily chart, everything has been trending as well. Higher highs on both the MACD and the RSI as well. We actually have a higher, just a slightly higher high here, and as you can see, the daily chart is diverging, so we don't have a higher high, we actually have a lower high. That would be a significant item for me to pay attention to. But I'd probably want to take a look at the weekly and the monthly chart. If they were trending really strong, then that wouldn't bother me as much. It would probably take several lower highs of divergence on the daily chart to turn around some of those higher time frame charts. Right here we have a definite higher high right here, but we have a significant lower high. Right here we have basically an equal high on the RSI, and then we don't have a higher high here. So I would want to take a look at probably the 8-hour chart, which is what I would do, and see if there's any divergence there. If we had a lot of divergence on the 8-hour, like we do on the daily, I would probably back off of this trade and look for something different. So that's kind of how I'd be reading that one based on based on the divergence. And if you could, you might be able to find a smaller time frame that didn't have any divergence and just trade the upward trend on a smaller time frame. And that means you'd be in the trade for maybe, maybe just an hour or 2 hours, and you can catch a quick run with this trend. But to hold this for a longer term, looks like we might have a pullback setting up. This could be a double topping structure right here. We could get a pullback all the way back down to the median level right here on this particular trade. And I really, in looking at this, I don't want to assume that much risk. Okay. So moving on to trade number 2, looking at 3 different time frames here, an intraday trade, the 1 minute, the 2 minute, the 5 minute. You can see on the 5 minute chart, we're getting a pullback right to in and around that zone, the 10 and 20 period moving average. On the 2 minute chart, we've got that set up right in the middle with multiple bullish candles, an indecisive candle. We just need to break up through the high of those 3 candles. The stop is right below the low of those basically 4 candles right there. Great setup right there. The 1 minute chart, moving averages are crossed over. Don't want to use that one. This trade setup is on the 2 minute and the 5 minute. Looking at the indicators here on the 1 minute, we've got a higher high here, a lower high here, basically a lower high or an equal high there. We're not going to use the 1 minute chart anyway. So looking at the 2 minute, we've got nice convergence all the way up to the most recent high. Same thing on the RSI. We've got at least consistent highs across the top. The indicators have gone flat. That's okay. I can deal with that. I just don't want a diverging structure. Here on the 5 minute, everything is converging very well. This trend is very strong at this point, and we've got a great setup, minimal amount of risk. Everything looks good. I'm in this trade 8 ways from Sunday. Trade number 3, we got the 2 hour and the 1 hour. Again, we can see the trade setting up multiple times ahead of this setup. Just tells me that the trade is working again and again and again. We've got the 50, the 20, and the 10. We've got a nice bearish candle setting up in the zone, looking for the close and the break of that. Another bearish candle setting up in and around that zone on the higher time frame. I'd probably take a look at the 30 minute. I'll also take a look at the 240 and the daily to see how much room there is to run to the downside. Got nice, beautiful convergence, lower lows. You can see that very clear on both the MACD and the RSI. A lot of strength left in this run. And then again on the 60 minute, just beautiful convergence, just heading lower and lower, looking to take the next leg of this low moving further. So everything looks really good on that trade as well. I'd be in that one again. So really a couple of nice trades there. One that that I would not take. Kind of gives you the difference between what good trades look like and what the not so good trades look like. Here are just a couple things for you guys to consider as we wrap up that you might want to do for yourself in preparation for part 3 next week. Before next week, do a couple of these things. Go ahead and spend some time reviewing trade setups, so you kind of start to get the concept cemented in your mind. So, because we're just going to be doing primarily all of these types of trade setups for the hour and a half next week. Okay, so preparing for that, create a watch list for yourself for the next week in your own charting package of the underlying markets for all the Nadex contracts that you're interested in. Spend the next week identifying these types of strategy setups, the momentum breakout and the trend flow, looking at live market price action, get some practice with the technicals that we've been talking about in these 2 strategies for the last 2 weeks. Try to find at least one example of each strategy over the coming week, or find multiple ones depending on what time frames you're looking at. Once you found your trade setup, look on the Nadex platform, see which contracts you would consider trading by first identifying your risk based on the underlying market price action. Remember, if you find a swing trade, binaries are the only contracts available on a weekly basis at this point. I think they might be adding weeklies to the spreads, but I don't know if that's done yet on the platform. Lastly, make it a habit of taking a screenshot when you find your trade entry in your setup. Then take another screenshot of your profit target when it's hit. So it's critical to have ongoing records of your trades. But those are some things you can do before the third session next week. That would be good for you to practice. And here, part 3, again, we're going to be going through all of the similar types of trade setups that we did today, with the exception that we're going to take it a step further next week by actually bringing in the Nadex binary contracts and the spread contracts. So we'll not only be looking for all of the price action, predictability, like what we did today, but then we'll actually be looking at the trade setup and then going to the Nadex platform, looking at what type of binaries and spreads, call spreads exist, and then understanding how to price out those contracts, how to get the trade to break even, how to navigate all the features of the trade setup that we're talking about, and get you fully absorbed and ready to trade Nadex binaries and call spreads with these two strategies. So this is the end of part 2. So hope you guys enjoyed that. You'll have the recording coming out to you shortly. Make sure you review that before next week, and I think that'll help you quite a bit. Let me see if I can wrap up with a couple more questions here, and then we'll sign off and get that recording to you guys and move on and get you set up for next week.